Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast. I'm Garrett Palmer, joined here with Ben Nye, and today we are going to hit on some macroeconomic themes. Usually we do earnings reviews, previews, or just talk about specific companies in the news, but we're going to hit on the macro theme because it's becoming way more important, especially under this administration. So do you think that the Dow hitting 20,000 means that you need to get out of stocks or cut pretty heavily?
Well, it's pretty incredible, because Dow hit 20,000 this year. It's already hit 21,000. Mm-hmm. And it gets a lot of headlines. I'm looking right now, it's below 21,000. So does that mean you have to get out? The Dow it's just a number, people. And every time you hit another 1,000 mark, the percentage move required to hit the next 1,000 mark becomes less and less. What you're seeing at the beginning of the year is just more expectations of higher growth, higher inflation, higher growth. So those combine, obviously, and you get higher nominal growth. And I think that's what's causing the rise in the market. And if you look at Dow, if you look at the S&P 500, which is a broader index, obviously, and if you look at the smaller growth caps like the Russell 2000, you see the same things happening, and it's just money's going into stocks because there is an optimism in both the investment community and the people who are actually making capital investment, CEOs, and that's translating to more optimism in the economy.
Right on. All right, next question is, why has Trump been so good for markets? Is it irrational exuberance?
That's a great question because it's one I get a lot. People like to have these fun little nicknames, like you've heard Trump bump. I'm sure you've heard got to get on the
Not
Trump
as good
train.
as the Tusk bump.
Not as good as the Tusk bump. And so what happens is that you see is a lot of times when in the media they like to look at one cause for a certain event happening. And the fact of the matter is that the economy has been improving for a while, and there was a large increase in optimism from CEOs after the election, and that's translating into real improvement. This is not just a sentiment-driven rally. This is sentiment that helped this is why you have bull markets, because sentiment drives investment. People are optimistic about where their business is going, so they invest more, they hire more. And that's just a fact of what happens in a more bullish time frame. Now, you said, is this irrational exuberance? I think you could get to a point where that's the case, but if you turn on the TV right now, it's where do I get out? Every conversation that I have with people is, should I start getting out now? I've been reducing my equity positions. I'm going to continue to be doing that. So that you don't have the animal spirits yet in the economy. You don't have people lending to people making $30,000 a year to buy 3 houses. So you're not at that point yet. And in order to define that inflection point, you have to look at a lot more than just where is the Dow now and it feels like it's high.
Yeah.
I don't like to make investments based on how I feel. I like to look at the facts and try to make an honest assessment with rational behavior about where I think things are going.
And I think I was looking at a chart the other day of like the Dow's historical PE ratio.
Yeah.
And it's not insanely higher than the historical average. It is higher, but it's not, out of control.
Right. Well, I'm glad you brought that up because there was a study done. Everyone's talking about the Shiller-Cape ratios. So the Shiller is it's basically a 10-year PE, which is attempts to smooth out the earnings and look at where prices are today based on the 10-year average of earnings. And people are saying, this is extremely high. Oftentimes when the Shiller-Cape ratio gets this high, you see poor returns in out years. But the problem is, when you're looking at past Shiller-Cape ratios, those are based on earnings that are actually have existed. Mm-hmm. So the reason the market is high is because there's an optimism about the future path of earnings, which is higher than where the analyst estimates are right now. So, yeah, of course, when things look pricey in hindsight, the values go down. Mm-hmm. But it's all based on hindsight. It's not a prospective way of looking at the world. So in order to have that prospective way of looking at the world, you need to create your own set of assumptions, and then based on those assumptions, then make an assessment. But just blindly looking at a ratio and just trading off of that, it doesn't make a great deal of sense to me.
Yeah, everybody wants to look at one chart and make the
Everyone
big call.
wants to look at their tell. Everyone has their tell. Yeah. What's your market tell? And it can get headlines, but ultimately, the people who have been using certain assets as a tell for the last 5 years have been short in a market that's doubled.
I always just make my investments off of who wins the Super Bowl, to be honest with you.
No. There have been worse strategies, I'm sure.
All right. The Fed is talking about hiking rates faster. I believe it's a 50-50 chance.
I think it's even above that now.
Above 50 now?
For March, yeah.
For March. And we still have to deal with Brexit, Russia. Deutsche Bank just raised billions of dollars in equity. $8.5 billion in equity. French elections are coming up. How is the market high when we have so many potential black swans?
Man, yeah, it's kind of like that thing. The worst thing is what you don't know, what you don't know, and I feel like there's a lot we know we don't know, but to really have a black swan, I think is a phrase that gets bandied about too much these days. But to really have a black swan, it's something you don't know that you don't know. And so the French elections. We had the Brexit elections. The problem is, again, kind of like what we were talking about Trump. It's tempting to look at an event and say, this is going to be the catalyst for a collapse. But it's not fair to look at it that way, because there have been so many events, so many head fakes, if you will, that everything's turning. For example, when Russia took over Crimea, that was a black swan that was going to destroy the market. When the Fed started to taper, or even talked about tapering, called the taper tantrum, and interest rates rose for a little bit, that really hurt the market. We had all these issues with Greece, and I don't want to. I'm not trying to just dismiss all these potential problems, but markets are risky, and if you're not prepared to be invested in a risky asset, then don't be invested in the stock market. If that's an issue for you, then just don't do it, because it's not going to change.
Index funds.
Yeah.
All right. What do you think could derail this economy? Like what? I guess this kind of comes back to you saying that people throw around black swan a lot, but
yeah.
If you have any potential threats in mind to the run.
Yeah, that's a good question. Because I just got all over saying, these
right. No, don't contradict yourself and name black swans.
And I think, once again, it's tempting to look at the stock market as a single asset. And there is some validation to the idea that correlations tend to go to one when bad things happen. But I think a lot of that is also due to the recent memories of the 2008 financial crisis. And because, if you look in 2000, for instance, you had the NASDAQ bubble, the tech bubble, but other assets, not all assets got hit. And we did have a recession then. But, so I think you have to just do your homework, figure out which sectors are potentially in a bubble, and then try to avoid the landmines. There will always be landmines. But is it trying to make a rational thought about avoiding those landmines? For example, there are some sectors in today's market that I think have been overly boosted by pricing, by government aid, potentially in the venture capital world. This money has been flying into a lot of these companies in the hopes that they'll one day become one of those unicorn stocks, like an Uber, like a Snapchat, which just came public. So I think you could see some bubbles there that you might want to avoid. We did have an industrial recession just a couple years ago. Fastenal was talking about that a lot. So you gotta be wary of these things. But if you can avoid those, I think the stock markets today are a reasonable risk.
Yeah, and that actually leads perfectly to my next question. Are you buying stocks here? I guess to answer that, you're buying specific sectors.
Yeah, I'm being selective about what I do. I'm not just buying blindly. I think there are actually, it kind of gets back to what we were talking about earlier. If you can find a company that you think has a better opportunities to beat expectations, if you think that they're on the right side of guidance, importantly, if you think management has a buffer that'll allow them to hit guidance and continue to impress the markets, then I think those are the companies you want to favor. Companies that are pulling every trick in the book, that tends to be symptomatic of someone backed into a corner, and usually that doesn't end well. So those are the things that I would like to avoid.
Right. All right. This has been the Investing Podcast. Stay tuned for more content. Thanks.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.